and what our research is mainly about is the rate of consumption and the impact of credit card debt on individuals and the U.S. economy and as a whole. And from the Department of Computer Sciences in Austine State University, Clarksville, Tennessee, USA. And my slides today will be bordering on the topics. The first one, evolution of credit cards, credit card debts, what it's about, and the importance of the study. And also I'll be looking at the economic impact of credit card debt. Then also, the causes and the consequences of credit card debt as a whole, and how it affects the U.S. economy. And also I'll be speaking on different data analysis that we did on credit card debts and how it impacts the U.S. economy and the benefits, and also recommendations to improve the economy for consumers and also for businesses. And so I'll be progressing on with my slides. About me, I'm just going to do a little bit of my background. Sorry, are you saying something?
Yeah, it's visible. Yeah, yeah. Hello.
Okay. Yeah, I thought you were saying something to me. I thought you were telling me something.
No. It's visible. Yeah.
Okay, thank you. So I'm a data professional. I've been working in the bank for over 6 years, and I've been working across roles such as a business analyst. I've also been a product manager and a customer experience expert. I have a BSc in physics, and I'm currently pursuing my master's degree at Austine State University in computer science and quantitative methods. I'm concentrating in data management analysis. And a little bit about my passion. I'm passionate about improving financial inclusion and driving operational excellence and impacting products to improve the general economy. Part of my interest is I did it for fun. I love anime. I also love Afrobeats. So let's get right into it. Credit is basically an agreement between a lender and a borrower, and it's basically any form of deferred payments extended by a creditor to a debtor. And the importance of this research is that it is very important for understanding consumer debts in many economies, especially the United States, because that's where we took our data from to do this research. And it's also important for improving financial well-being and improving individual financial health, affecting customers' ability to save, invest, and achieve financial goals. So understanding credit card debt would help individuals to, manage their finances effectively. So there are various ways you can get credit, especially through the US here. You could get it through credit union loans. So it's not just the credit card. There are personal loans, through personal loans. When you get a loan, you secure it with a collateral, like a car or a loan. And it can also be unsecured, based on credit worthiness. There are also home equity loans, where home users use their homes as a collateral to borrow money. And also there are auto loans where borrowers can finance purchase of a vehicle through an auto loan, where this vehicle serves as a collateral. There are also student loans, and these loans are designed, to finance higher education expenses, including tuition fees and living expenses. Payday loans are short interest, high interest loans that borrowers can use. Can quickly access cash. Typically, it's usually due on the borrower's next payday. And these loans are usually not very advisable because they are usually considered predatory because they have really high fees and interest rates. There are also installment loan, various tools that their customers use to get loans from financial institutions. And then I'm just going to talk about the recent trends when it comes to loans. And these are memes that I've gathered across the internet. And this is basically, what the mentality when it comes to a debtor and a creditor. The first meme talks about it captures the feeling that most of debtor have experienced when they are repaying borrowed money. It's humorous, it's funny, and it highlights the emotional weight of debt repayment and the pressure to meet financial obligations. And I'll just show a little bit more of the memes I gathered across the internet. I look forward to paying all my debts and, finally getting to being broke. These are things that borders on the minds of debtors and the way they feel about, having debts, having loans, and paying off their credit cards loans. And this is the final meme that I have for students. Students have the students loan you're going through, and you're paying off your tuition and your fees. These are loan memes that a lot of consumers that we've gathered across the internet, the way people feel about having these loans in their finances. And the objective of this research is basically, to identify factors that contribute to accumulation of credit card debt amongst individuals, the consequences and the relationship between credit card debt and various socio-economic factors. And also we examine the impact that this debt has on personal consumption of consumers, the gross domestic product, and economic stability of the nation. And I'll start with the evolution of credit cards because we had to do a clear research on how we got to this point. In the early 50s, credit cards were like restricted to specific merchants until Bank of America, created the first card. Then they formed Visa. Visa became a separate entity, and between early 1950s and now, credit card has really, it has the evolution has been massive, and now over 175 million Americans possess at least one credit card. So the transformation has been intense and been very impactful. And credit cards now play a very central role in the US financial landscape, And this is also as a result of the market decision where banks are able to set interest rates based on their chartering states. So this regulation, it helped banks to be able to apply interest rates at their own pace, and also increased credit card usage amongst low-income households. So this also led to a very high increase in credit card debt in the US economy. And so credit cards debt, basically what it is it's a form of liability. It revolves around the credit card loans, and it accumulates with your credit card balance. By early 2008, households with every household that at least one card that had it has accumulated 20% of the income in credit card debt. And in the second quarter of 2023, credit card balances surged by $45 billion to a all-high record of $1 trillion. And this is even higher than mortgages and every other kind of loans. And our progress causes of when we analyze on our research and the data we gathered, we identified the major causes of credit card debts. And the first one is is due to economic factors, and economic factors, consumerism, then also high healthcare costs. These are the major causes of credit card debt. Economic factors such as recession and job losses, and it led to a lot of people relying on credit cards to cover expenses when income is reduced or is unstable. And consumerism, the culture of consumerism here in the US, it promotes overspending, and individuals try to keep up with societal expectations, and this led to impulse buying, lavish lifestyle, and you want to keep up with the Jones. So this led to excessive credit card usage. Then also the cost of healthcare here in the US is very high, and even with insurance, and a lot of individuals faced substantial out-of-pocket expenses for medical treatment, and this placed a lot of stretch on their credit cards. Then also the accessibility to credit cards. Getting credit cards is very, very easy here in the US, and it makes it, if the accessibility has led a lot of individuals to accumulate debt, without fully considering the ability to repay. Then lastly, lack of emergency funds for unforeseen emergencies. Then statistics that we researched also states that over half of Americans have reached their credit card limits at some point. 29% admit they've maxed out the credit card every month, and 43% usually spend more than they usually earn. These statistics basically points to the fact that credit card usage and financial management among Americans it's at a very critical stage. And the consequences basically of this is that it impacts financial well-being. It also have effects on your credit score and savings, then physical and mental health, and strain on personal relationships. These are the consequences of accumulating such debts over time. And we move on to the economic impact on the economy as a whole, and it's two sides to a coin. And we realize that data shows that it also acts as a revenue generation for financial institutions, based on the interest rates and the annual fee and transaction fees. So financial institutions profit from interest payment by cardholders to on outstanding balances. It contributes to the bottom line. Then also stimulates consumer spending. You have a credit card, it motivates you to spend higher, and the convenience that credit cards offers have made consumers to make purchases. Though in general, this also boosts the spending level of the economy. It also leads to another economic impact of credit card debt. Also, it shows e-commerce growth, and credit cards has played a crucial role when it comes to facilitating e-commerce transactions, and this has driven the growth of online retail business. Then also it has also led to it could also lead to economic instability, where high levels of consumer debt can lead to financial crisis where there's excessive borrowing, and in extreme cases where there's defaults on this credit card debt, this will trigger a broader financial systemic risk and contagion, and this will impact financial markets and the economy as a whole. Then strategies that we outlined on this research are prevention strategies, and also debt management strategies, and the ways by which we could strategize and better manage credit card debt on the economy. It leads financial education and literacy, improving financial education and equipping individuals with the knowledge and the skills to make a better informed financial decisions. Then budgeting and planning, establishing emergency savings funds, responsible card usage, and also managing debt. It calls for comprehensive budgeting for debt, then focus on paying high interest debt, then overall debt consolidation. And move forward, analysis that we did, delinquency analysis showed that from data gathered from consumer credit report from the Bureau of Consumer Financial Protection, it shows that the trend analysis shows that a lot of people struggle to pay their credit card bills in 2019, and this is a problem that we've seen since the big economic downturn a while back, and this trouble peaked. You can see this trouble peaked at the end of 2019, and this means that a lot of folks were having a very tough time, keeping up with credit card payments. And there was also an impact of COVID-19 relief measures. Starting in early 2020, fewer people were late on their credit card payments because of the economy as at that time due to COVID. Then on delinquency, there was a convergence on delinquency rates, and the late payments for regular credit cards and store cards got closer in numbers during 2019 and 2020. And that's basically because stores were giving cards to people that might have trouble, getting them before, and everybody was getting cards at the same time. Then we also did analysis on credit card risk, on data gathered from UCI machine learning repository, where we analyze different customer characteristics in order to better predict if a customer would default on their credit by the next month. And we gathered a lot of features like the limit balance limit, sex, the education, marriage, age of these customers, then also the payment plan, the payment for the first pay 0, pay 2, pay 3 shows the repayment status for this set of customers. And we applied the logistic regression to be able to classify if the customer would default on the next month. If the customer defaults, it's going to be 0. If it's going to be 1, if the customer doesn't default, it's going to be 0. And the feature analysis that we did a lot of feature analysis to be able to better predict for this default rate for these customers. And we identified the most important features that contributed to our model evaluation. And the features that we used that contributed the most were the prepayment history for the first 3 months, then also credit limits, and marriage status also play a very important role to predicting whether a customer would default on their credit payments by the next month. Then also age, age of the customer also played a huge part important part in also predicting if the customer would default by their next repayment date. So these are the features and the coefficients we use for logistic analysis. And then these are the rates. This is a graph showing the repayment status on and how important these features and the characteristics for the customers customers that would default by the next payment status. And this model gave an accuracy of 80%, and it was very effective. It helped us differentiate and distinguish between customer defaulters and non-defaulters. And this was basically on identifying the characteristics of this cardholder and their behavior and on payments and previous payments and their history of payments. And also this is a currency demand analysis that we had to do, correlating the behavior of our customers when they use their credit card and their debit cards in relation with physical currency. And we realized that there is an uptick, there is an increased usage for credit card. Why there's an increased usage for credit card and debit card? There is a reduced usage for need for physical currency. And this is basically because more people use credit card and debit cards. And as they use these cards, the need for physical money decreases. And this trend is because credit card and debit cards are becoming more popular, a more popular way of doing things, of completing transactions. And this study also, points out the effect of debit cards on reducing the need for cash. This is very significant because people use debit card to withdraw cash from the ATM, and also payment technologies prefer when customers use credit cards and debit cards, and this made the use of physical money more, less necessary. And the regression analysis we did comparing personal consumption for individuals in the United States against GDP, and also against credit card debts. And their regression analysis estimated data on credit card debt, GDP, and personal consumption. And this methodology we use the OLS regression. It helped in investigating the relationship between these variables, and it strengthened our research based on quantitative analysis and statistical validity. And the objective that we had, this analysis helped us, to be able to gauge the influence of credit card debts on personal consumption, and also measure the relationship between credit card debt, GDP, and personal consumption. And the analysis is basically a time series data spanning from 1999 to 2022, and the data was sourced from the Federal Reserve of the New York database. We use this data for this study, and the regulation analysis revealed a significant positive impact on credit card debt on personal consumption in the USA. And this basically shows that $1 trillion increase in credit card debt corresponds to an increase in personal consumption, and this is indicated by the coefficient 22.39. And there is also an impact on GDP. For the impact on GDP shows that there's a significant positive impact on GDP of the US. $1 trillion increase in credit card debt leads to substantial increase in GDP, and this also indicated by the coefficient 32.52. The implications of our findings shows that there is overall economic performance, and it plays a significant role. Credit cards predicts an improved economic performance as credit cards debt increases. And this also plays an important role in debt dynamics, where an analysis reveals that credit card usage and debt levels would improve the economy, and also affect the way customers spend, and also business revenue, and the trajectory when it comes to economic growth. And this also plays an important role in policy, governmental policy, and the intervention that needs to be made when it comes to risk that is associated with excessive credit card usage and credit card debts, and also the way institutions and financial institutions attend and manage customers' data and behavior when it comes to um, credit in general. And so the recommendations of our research points to policy reforms, transparency on credit card usage, then improved financial educations, public awareness, to educate consumers about risks and benefits of credit cards, to emphasize the importance of responsible borrowing, and also a complete collaboration between all stakeholders that are involved in credit cards disbursement management, and also education. So government agency, financial agencies would need to collaborate in order to address the challenges that has been outlined in our study, to better manage the risk when it comes to excessive credit card usage on the economy, and on the impact it makes on individuals. Then also, we move on to the benefits of this research. The benefit of this research would improve financial inclusion as a whole, would lead to reduced financial stress for individuals, and would also improve financial literacy. It would lead to long-term economic growth for the US economy, and protection for consumers, card holders in general. Then also globally, better management of consumer credit card debt will lead to an increase capital flow, diversification, then trade in general. Then this also we also talk about the better informed decision making when it comes to the payment processing ecosystem that's involved in the whole credit card disbursement uh, ecosystem. We have the acquirers, the processors, the issuers, Citibank, Bank of America, different card networks. Everybody has a part to play in this decision making, and even the customers and the card users has a part to play. And this leads to better informed decision making when it comes to managing credit card debt. Then strategic action planning. Strategic action planning basically speaks on setting realistic financial goals, creating budgets, and establishing emergency savings funds, to reduce risk of relying on credit cards during unexpected financial crisis. And strategic action planning speaks on individual account management and also for US businesses. US businesses who can utilize the findings to inform strategic action planning that is related to credit card acceptance, payment processing and customer engagement. When these businesses align their strategies with the recommendations, it would contribute to a more sustainable and equitable credit card ecosystem that would lead to long-term growth and relationship between the US card financial institutions and their customers. And that will be all on credit card debts and its impact on individuals and the US economy. Thank you very much.